In just 48 hours, China has pulled a staggering $1 trillion out of U.S. financial markets. Stocks are plunging, the bond market is in chaos, and the dollar is showing cracks we haven't seen in decades. This isn't just another headline. This could be the start of a global power shift. Subscribe now, because what I'm about to tell you will change the way you see America's future. What if this $1 trillion exit isn't just about simple market moves? What if it's part of a bigger, carefully planned shift in global finance? No breaking headlines, no public statements, yet the ripple effect can be felt in every market from New York to Singapore. In the world of finance, timing is everything. The moment investors change where they place their trust, the entire balance can shift. And here's the interesting part. Some analysts believe this withdrawal happened at the exact moment to trigger a series of changes in currency flows. In just a few minutes, I'll share the key indicator experts are watching that could confirm this. Stay tuned. Sources close to Beijing confirm China has liquidated massive U.S. debt holdings and is moving reserves out of the dollar system. This isn't random. For years, China has been America's largest foreign creditor. Pulling out $1 trillion in 2 days is not a market adjustment, it's a strategic strike. Why this matters? U.S. Treasury bonds are the backbone of America's borrowing power. They fund everything: military budgets, infrastructure, social programs. When a major holder like China dumps bonds, demand collapses. That forces the U.S. to offer higher interest rates to attract buyers, which means more expensive mortgages, car loans, and credit card debt for American families. The BRICS factor. This move didn't happen in isolation. BRICS nations Brazil, Russia, India, China, and South Africa have been building an alternative financial system to bypass the dollar. They've been buying gold, trading in local currencies, and now quietly reducing exposure to U.S. debt. China's $1 trillion withdrawal is the loudest signal yet that the dollar's dominance is being challenged. Market meltdown. The Dow fell over 1,200 points into sessions. Bond yields spiked to multi-year highs. Gold surged past $1,500 an ounce as investors scrambled for safe havens. Even Bitcoin rallied, breaking $80,000 as traders looked for alternatives to the U.S. financial system. For Main Street, this isn't just about Wall Street billionaires. Rising interest rates will hit everyday Americans hard. The average 30-year mortgage rate could soon cross 8%. Auto loan payments are climbing. Small businesses relying on credit lines will face higher costs, forcing layoffs and price hikes. Behind the move, why now? Analysts point to several triggers: escalating trade tensions, U.S. sanctions on Chinese tech, and Washington's closer ties with Taiwan. But there's a deeper game here. By weakening the dollar and destabilizing U.S. debt markets, China strengthens its own currency and expands influence in global trade. The risk of contagion. Other U.S. debt holders, like Japan, Saudi Arabia, and European nations, are watching closely. If they follow China's lead, America could face a full-blown funding crisis. That means the government would have to either slash spending drastically or print money, both of which could send inflation skyrocketing. The takeaway: we're witnessing a financial chess move on a global scale. China just called America's bluff, and the consequences will be felt in every paycheck, every grocery bill, and every retirement account. Subscribe right now, because in our next video, we'll dive into how BRICS could replace the dollar entirely, and what that means for you.